If someone were to explain these two concepts to me back in 2020 before I lost money for 13 fucking months straight, I would have saved so much cash in my account, but I didn't. So I'm giving you an opportunity right now, today, to understand the market in a whole different dimension and for you to actually, for once, have an edge over the other market players through information and knowledge. So if you truly want to be a trader, please stick with this video because this was a revelation for me in 2021, right? So these two concepts are absorption and trapped traders, and I cannot tell you how important they are. First, we have to explain what these things mean. So the absorption, you might have heard of these terms, and what that basically means is it's when a limit positions are sponging up, absorbing the orders coming from market players. And this is something that happens every single day because in the market, at every price, there is limit players and market players. And for you, you might think that this is something small or, not something convenient to you, but it actually is everything to the market. And when I say everything, it's every single thing to the market. And first of all, we have to understand what limit orders and market orders are and why they're important for you. These two things could be just two buttons you see on your exchange where if you press one of them, you can choose the price you want to enter. If you choose the other one, you enter the price right now, enter the market right now. So it's actually so much bigger than that. And the reason why it's so much bigger is because limit orders for a good trader represents big players in the market. There's three big reasons why that's the case, and I will give you two of these here and the other one at the end of the video because it actually fully ties up to that main idea as well. So first, the first two is you don't pay fees when you enter the market with limit orders. Now this is big for you. If you're trading with $100, $1,000, $10,000, it might not be much because those fees, 0.01 fees, might not matter to you much. But if you have $100 million in your hands, or if you have $1 billion in your hands, those fees add up. So you don't want to pay those fees. So that is big. That is why those big players always enter the market with limit orders. And the second reason is, those people don't want to time the market. They don't have, they don't want to be in their computers all day looking for a price level to be hit. They would rather put limit orders at a certain price they're interested in and then just leave the market. So that is two reasons why big players love to use limit orders. And the market orders are orders where you have to pay fees every time you enter the market. And when you're entering the market, you have to enter the market at the current price. So you have to time the market. You have to be on the charts when the levels that you're interested in is getting hit. Now, the best way to look at these things is through how forces work. And you're seeing here a dude trying to push this red block inside this house through this wall. But unless he has more force, he is pushing the big block width that it is actually bigger than the force that is being applied to this red box by the wall, well, he will never be able to push it through it. And the easiest way to see it is these are the limit orders in the market, and this is the market orders trying to push the price beyond those limit orders. And this is exactly what happens in financial markets every single day. This is a price. This is a thing that I've pulled from Bybit. You're seeing here 94,100. There is 120 Bitcoin orders. There's 134 here, 145 here, 85 here. So these are just limit orders sitting here, and other way around on the buy side as well. Now, the only way bulls can pass through those $94,100 price is if they have more than 120 Bitcoin market buy orders when we hit that level. Because if you're not able to push through with bigger force than 120 Bitcoin, you will never be able to get past through this. Well, there's obviously different factors, like they might pull the price down or they might pull their orders, but let's just focus on this now for now. So what you can see here is it's a war between the attacking forces and defending forces. You see 120 Bitcoin being attacked by those market orders of 30 Bitcoin, 5 Bitcoin, 15 Bitcoin, 0.1 Bitcoin. So they're all gathering up to attack that big force that is sitting there as the wall. Now, you can always think of them as soldiers as well. So here you can see 6 soldiers defending against 3 soldiers. And since these soldiers represent Bitcoin or like prices, they're the same thing. So this guy is not stronger than this guy. So the only way the bulls, the green ones, can beat the red forces is if they outnumber them. And in this case, they're 3 versus 6, so they cannot beat them unless they find more force to actually join them. And in this case, you can see now they're 7 versus 6, which means they will be able to beat them. And, well, it's a victory. Now they were able to conquer that big level that they were trying to pass for, however long that fight and the war was going on for. Now, what do they do next? Well, what they do next is they have to do this at every single level, because that's how the market works. At every single level, there are limit orders sitting, and the attacking forces have to attack them, beat them, and then go on to the next level. Now, the important thing here to notice is these guys here, they are retail. So they're not actually planning things together. They're all different separate forces. But these guys here, as we talked about, they are limit orders placed by big players. So they are actually working together. The two things they can do is, first, what they can do is they can actually get on this formation here, which is 5-4-5, or what they can do is they can actually retreat these people back so they don't lose soldiers here, and then concentrate their camps on a different level and a different area, so that when the green people come and attack them, now they cannot be outnumbered because they are such a huge force. And what this will lead into is, when the green forces were first targeting these levels, they will see basically really little to no resistance when they're hitting these levels, which means when they're conquering these lands, they will think that they will win, because they had targets in their minds like these levels here, and they were conquering it, and they're happy because they achieved what they wanted to achieve, not knowing that this was about to be a slaughter by the red team, because they have concentrated their whole team into this area here, which means now when they're trying to attack these forces here, it's about to be a opposition's forces that's about to slaughter them. And that's exactly what happens here, which basically, since they're getting outnumbered, these guys get killed, and these guys as well. And what you're seeing is the once defending forces now go to the attacking forces because they're outnumbering them by a huge margin. And what usually happens in these cases is you always see when those big amounts of green forces being attacked and killed, the other forces who were defending ones, they now start the attacking as well, because now they're outnumbering them at every level. And, well, the tides shift, and now the red forces are the ones who become the market buyers, who become the attackers, and the green ones become the limit defenders, the wall. And that's basically how the market works. Exactly how it works in the financial markets as well. It's a war between limit players versus market players. And what you will see is this will happen at every single price level there is. So the way I was able to visualize this and never forget about it was through a real life example, which is the Napoleonic campaign versus Russia when they were, getting Moscow back in 1812 in the 19th century. And you can see this is the attacking plan they had. And the problem with the Russian army at this time was at every single place they were getting outnumbered by the French army, because the French army had 600,000 people with the alliances combined. So what the newly appointed chief of war, the Kutuzov, what he did was, well, rather than trying to fight Napoleon and his army at every single area here, what we can do is we can actually concentrate our troops at a certain area and then attack them when they don't expect it. And he came up with this idea in this room right here. This is the Kutuzov guy. This is a painting made by an amazing painter called Kivchenko. So in here you can see him and his young generals, and when he came up with an extremely unpopular idea of, well, how about we actually give Moscow away to Napoleon, because at that point they will think that they have won the war, and then retaliate after they were able to, they think that they have won. So what they did was they did not put any troops or very little troops to all of these areas right here, allowing Napoleon to conquer these lands and even Moscow, not knowing that their plan was to actually go back, retreat, and then attack when the opponent was not expecting. So here you can see he came up with a quote saying, "Napoleon is a torrent which as yet we are unable to stem. Moscow will be the sponge that will suck him dry." And that's exactly what happened. One of the most amazing decisions made by a human, probably a general ever. And this is a picture again made by Albert Adam, I believe. And Here you can see Napoleon inside Moscow, actually conquering Moscow, doing what many deemed as impossible to do, but relying on the fact or relying on the idea that, well, if I conquer Moscow, all of my troops who are completely tired now because they had to come from France to Russia, they can rest here because in Moscow there will be supply, there will be food, there will be shelter, not knowing that Kutuzov and the army and the people of Russia making an amazing plan of just burning down all of the shelter and the town and not leaving any food behind for the French army. So here you can see the French army believe that they're victorious, finding out that there is nothing to actually feast or, you know, be happy about at this point. And well, Napoleon came up with a amazing idea of going out with a peace treaty to the Russian army, but Kutuzov and everyone else said, well, fuck you, we're now going to retaliate. And what happened is the Russian army completely blitzed the French army, who was fully demotivated and also tired as well, and then conquered back all of the land that Napoleon once got from them. And they did this because they had an amazing plan in hand, which was to concentrate our troops at a certain level where the opposition does not expect us to be at, and then just let's blitz them and become the attacking forces against them as well. So I think that explains how the market works in this case as well. And again, you might say, how does this relate to absorption? But it relates really well, because the market, just like I said, works in two ways. It's limit orders and in market orders. And for us, the market manipulation, the concept that you might have heard on Twitter a lot, works and happens because of limit orders. So when a limit order is being placed, the reason why it's being placed is because a big player is making a plan of entering the market at a certain price. And the best way I can explain to you the third reason I was talking about in the beginning of the video, why these limit orders are so important, is because let's think about a guy who has $100 million in his hands that wants to short the market. And he's thinking to himself, well, what I can do right now is I can try to enter the market right now. Right? He can short the market right now, but what he will face is, as he's shorting the market, he's actually going to push the price down because of his sheer size. And while his entries are being filled, the price will push down and his average entry will be a lot lower than what he first anticipated, which will leave him with a not that much of a profitable position. And the second thing he can do, rather than saying, okay, this is good, the second thing he can do is he can think about this. Well, where can people actually give me their positions? Where can I short the market without actually pushing the market down? Well, the place he can do that is if he's able to identify where these people who are shorting the market at this levels with him are putting their stops at. Because if he's able to identify where these people are putting their stops, he can just buy those stops from them, so he can enter the market at a better place where people are willing to give their positions to him. And well, you can answer these questions to yourself as well. Like, where do you think the people who are the retail who is shorting the price at this blue circle will put their stops? Well, it will be here. And when they're putting their stop losses here, what a big player can do is he can place limit short positions just above those highs. So when those people are getting stopped out, he can actually get into those limit shorts at so much better prices without pushing the price down, because these guys who are having stop loss levels hit here, they have to buy back their positions, which, when there's a shorter and there's a buyer, well, these guys are not actually pushing the price down. And then when he's entering the market here, maybe he's leaving one position behind here, but he's having a much better position here because his risk reward is much better, and also it's, he doesn't have to push the price down because he identified a great level that he can enter the market. Now, this kind of moves happens with patterns, and those patterns are the failed auctions, swing failure patterns, and the failed impulses. I think I will talk you through these two first because they are a lot more common for Bitcoin. And what you will see is this is a really classic swing failure pattern where you will see the price push sideways for a long time. This is 2 days of basically the same $1,000 range, and then you're seeing the price push up above these highs here, taking those highs and then pushing down. Well, the reason why this happens and why this is so important to us is because like the same concept as the blue circle there, let's think about where these people here, if they're shorting the market at these levels here, where do you think they will put their stops at? Well, they will put their stops here, because even if I was shorting the market here, I would just, like, the first place I'm thinking about putting my stops will be here. So if I'm a big player who wants to enter the shorts here with 100 million or like $500 million, I can short the market at these prices here, but I will just push the price down. Rather than that, what I want to do is I want to enter the market where people will give me their short positions. And for us, for the market in this range, that level is above this high here. Because if I'm able to trigger those stops that are basically waiting here, I can buy those stops and convert them into a short position there without pushing the price down. And that's exactly what happens here. They push the price up, get those stops here, fill their limit short positions, and then push the price down. And this is what we call a swing failure pattern, where it just wicks above the high and then continues in the other direction. And the other way this can happen is a failed auction. In the failed auction, you will see the price move sideways for a long time, just like on our swing failure pattern example. But with this example, what you will see is, well, the beginning will be the same, where there will be a high where if anyone in this market, in this range, is shorting, that it's a place where most people will put their stops at. I mean, you don't have to even imagine. You can just ask yourself, if you're shorting the market here, where is the most likely place you will put your stop loss? Well, it's here, right? Even for the best players in the market, it will be here. If you're believing in your position, it will most likely be the closest high that you have, or a different high that you will have. So that's why those highs will have a lot of liquidity building there, because there will be a lot of stop loss placements there. Now, what happens if a big player with $500 million tries to short the market here? He will push the price down. But what he can do is he can put his limit short positions here. So when the price actually goes up there, he can actually get filled in his positions without actually pushing the price down, because there's already people who are buying back the price, which actually they're not buying, but they're actually just buying back their stops. That's what they're doing. And also, what happens with the failed auctions, the difference between the swing failure patterns and the failed auctions, is you will see the price actually consolidate above a range in a failed auction. So in this case here, you're seeing the price consolidating above $63,000 for around 2-3 days. And the reason why this is so important for us is, well, imagine yourself. Imagine you are a trader who wanted to long the market in this range here. This is a 15-day range. So if you wanted to long the range right here, but you couldn't, you will have a huge amount of FOMO here as a retail, because you believe that you just missed the move and you just, you feel like you have to enter the market. And what you will face here is, as you're buying into the market, you'll see the other big players actually limit shorting your buy entry, so they're getting filled without actually pushing the price down, because there is enough FOMO players entering the market. And what happens next is, well, we're seeing the price push down heavily, which these people here who have been longing the market there are now trapped, which is what basically gets the move this violently here as well. So those are the two concepts that are really important for us, because it shows us both absorption here, which basically means limit shorts absorbing the price here, plus it shows us trapped traders as well, because anyone that has longed the market at the highs here, when the price goes back below the range high, now they're trapped there. And when they're actually leaving their long positions, they will push the price down, because anyone who has to close their long has to open a short position. They have to sell back their positions. So that's what the trapped traders concept coming from. Now, swing failure patterns and failed auctions are the most proven absorption patterns in the market. I've seen them for the last 5 years. They work really good, and they are the thing to look for in the market. And the best ways to detect absorption is through CVD divergences and through the open interest increase. Now, if you don't know about CVD divergences, please watch the video about it. And if you don't know about open interest, I will make a video about that soon as well. So you'll have both ways to detect absorption. But for the CVD divergences, what that gives us is, when you're seeing CVD bearish divergences at the highs here, what that shows us is, okay, there's a big player entering the market here, but also there is small players who is entering longs as well, Well, that is a perfect combination for us when we actually get back into the range, because now we have trap traders, we have absorption, we have big players shorting. That is the icing on the cake for us. Because what we're looking for here is, and what range trading and what absorption and trapped trading means, is me trying to identify if this breakout is an actual breakout or is it a fake out. And if I'm able to do that with high percentages, well, I will make money. And that's what absorption and trap traders are about. Now, for you, here is an example of when we were taking those $90,000 lows back in, I think, earlier this month, right? Yeah. And what happened in this move is you can see that the delta and the CVD was moving down heavily. We saw $200 million of volume, but the price was not pushing down. So even though there was more shorts coming into the market by retail, the price was not going down because there was a big player who was buying back those orders. So there was big players who were putting limit longs below $90,000, and when people were getting liquidated, stopped out, or entering shorts, those big players were actually longing the market with limit longs. And that's why the price was pushing higher, even though the delta was negative. So this is another example of it as well, of a trap traders here as well. So you see here the price pushing down with 17 million negative delta, 6 million negative delta, 6 million negative delta, but the price is not going down. Like, you're seeing this much shorting, but the price is making higher lows. How can that be possible? The way that is possible is because the people in the market are shorting, but there's a bigger player in the market who is limit longing the price. And for us, this is the perfect scenario of the trapped traders, because imagine everyone who shorted the market at these levels here. Like, there is 6 million more shorts coming in here than longs. So these people who shorted the market here, what will happen to them when the price is pushing up? Well, they will be trapped. And when you're seeing a lot of trapped traders here, and you're seeing absorption, which means a big player entering the market with limit orders, that gives you a perfect trade entry. Because at these lows here, below $98,000, you're seeing a lot of shorting into the market, and you're seeing a good amount of absorption from the big players, and then you're claiming a big level like the weekly. And if you don't know about weekly, daily, monthly levels, please watch the video about that as well. They're good levels. And here, I'm just using that level as a benchmark level, where if the price pushes down, and if I see a lot of players in the market who are shorting the market at these levels, well, once they're trapped, what will happen is they will be the fuel. And that's exactly what happens here. They become the fuel for this major move. And again, this is not an example that I'm just looking back on. It was a live trade that I gave on the Discord channel of the tag team. So these things happen every single day, because big players and small players, they're always in the market every single day. So I hope that was helpful for you. And what to look for in the market for me every single day, what I do is I look for absorption, I look for trap traders, and I also look for ranges. With these three concepts in your hand, if you just master them, I promise you, you will become the 10 times the better trader that you are now. And you can learn about these subjects more if you want to, master them. You can learn through these books. These are from Jim Dalton's website. They are amazing books: Mind Over Markets, Markets in Profile, and Trading Psychology 2.0. They're all amazing books. I've probably read them over 5 times each, and they're really good. And if you're not good with reading, if you're better off with having mentoring or learning them one-on-one, I'm here to help you as well. If you want to have it in the tag team, you're always welcome to join the Discord or get one-on-ones with me. So I hope that was clear. I hope those concepts were now a bit more familiar with you and why they are really important to the market. And if you want to learn more through me, and if you want more of me, you know where to find me in the Discord channel. So see you in the next video, and bye-bye.